Welcome back, everyone, to the program. As you can see, it's more of a whiteboard day today. I've got some stuff in front of my face. We're dealing with that. I just wanted to put it out there. I don't know why it's so large, but I'm going to work on the sizing at some point. But you can see, hey, if you need any help with anything on anything I talk about, LitecoinLeader.com, and there's the phone number. I'm going to talk over that for now and get to the whiteboard in a moment. But as you can see, I've been doing videos on history of the gold standard. You know, it's a little harder to read right now. I'm going to wipe this off, but I wanted to talk about what's going on with the Federal Reserve. And also, we're going to do some economic videos too. We're going to talk about supply and demand. I'm going to shoot a couple of things. Hopefully you can't pick up my neighbor who's putting up new siding, but all this stuff is going on, and I wanted to give you guys an update. We are going to be doing an Economic Preppers video tomorrow. Dylan and Patrick and I, just to catch up on things. You can find us down there on the ticker. We'll be in Las Vegas at Caesar's Palace. Tickets are starting to sell out. The rooms are starting to sell out, so please get them ahead of time. Use the discount code in the description for $10 off or 10% off. It's about the same thing. Tickets are normally $99, so you get $10 off. And it's going to be a great conference. We have a lot of speakers, a lot of people coming out there. We have new sponsors every day, new booths showing up, lots of good stuff. But let's get to the purpose of the talk today, which is the Federal Reserve. Okay, the Federal Reserve hiked rates again. Now, the Federal Reserve is stuck between a rock and a hard place, in a word. And I don't know if I'm going to get to, but so interest rates are actually, let's see, they keep ticking up interest rates, and they did it at a record pace, and they were basically zero, and then they went up, pause. They never went down, and they went up a little bit more. Now, this point here that they're at now, I think we're at 5.5. Roughly speaking, they never give a solid number. They just said we're up a quarter of a point or 25 basis points, which makes it sound larger than it is. It's 0.25%. That is what they raised. If you think that matters today versus yesterday, not so much. Not only that, but there is a time factor to this. This gets delayed, or excuse me, the impact of this isn't felt for like 12 to 18 months downstream. This is an early warning sign that this will impact banks and real estate much longer, and the bond market. So now as they raise rates up, bond prices will go down, which hurts bonds. Fewer banks will be able to lend because people don't want to buy, don't get these loans that are difficult to get as is. It's hard to qualify for loans because understand, like, so banking is, so let's talk about the impact areas. We've got banking and loans. All right, sorry for the glare, but you can see it, banking and loans. That impacts cars, real estate. Sorry for the alarm. A little out of practice here. Cars, real estate, mortgages, bonds. Bonds are a separate market, but that it works with the banking and the loans. So all these things are going to be impacted by this, but it's 0.25%. And of course, interest rates on credit cards and other things too. But you're going to see volatility in Bitcoin. You're going to see volatility in stock market. You're going to see volatility in a lot of things. As interest rates go up, the price, the DXY, the dollar goes down, the dollar goes up because now you're getting more interest from that, but the price of Bitcoin goes down. It's just the way it works. And then bonds, the price of bonds will go down because older bonds, because if you have a bond now that's paying 5.5%, why would you buy a bond that was paying 2% from a couple of years ago? You have to buy that at a discount. So let's just say it's $1,000 bond. You might be only worth $900 now because you're only getting 2%. So if you had a bond that was $1,000 face value at 2%, 2% of that is $20, right? So that bond in a year is worth $1,020. Okay, so I could spend $1,000 and get $1,020 later, or I could spend on a new bond today. Get this, I would get 5.5%. 5.5%. We're talking about $55. Right, versus 2%. Now that's a $35 difference. So what happens is the older bond, like, they need to be equal for them to be on a level playing field, right? So The new bond is worth 1,000 plus 55 when you're done. The old bond is 1,000 plus 20. So the old bond, you have to knock 35 bucks off of it to make it equal, because at the end of the day, the new bond is going to be worth 1,055 in a year because you get the 55 of interest plus the original money back. But if you spend $1,000 in the old bond, you only get $20 back. So now where's the other 35? What's the incentive for me to buy this? But if I slash this price to say 970, it might be appealing to you. I could spend 970 and it'll be 1,020. It will still be worth 1,020. And that's competitive with 1,055 because I'm spending 970 versus 1,000. It's competitive. So that's why bond prices go down when interest rates go up. So of course, the other things that are easier to tell: credit card payments, real estate, mortgages, car loans, anything which involves a loan goes up in cost. Okay, so that's less appealing. Banks have difficulty making loans because not only do they, it's not the bank's fault, because the bank has a business model. The bank has to sell that loan. They don't keep loans. Like old school banks would keep loans in-house, and a lot of credit unions, they would do the same thing, but they don't do that anymore. They have to sell it. Okay, they have to be in a market, and they have to make it, again, appealing to a buyer, much like with a bond. So why would someone buy a loan, let's say, that's paying 6% when you can get a new loan that's like 12%? And this is so again, the rates, the higher the rates, the more appealing it is to an investor. But the lower the rate, the less appealing, it's more appealing to the borrower. So now money is, the currency supply is tighter in the lending area. And this all this makes a lot of impact on these different markets. So real estate is going to have problems. Car loans are already having problems. Car companies will have problems. Real estate companies will have problems. Anyone that's associated or tied to cars, real estate, bonds, or bank loans, those industries are going to be impacted. So all these things are impacting. So what do you do? So what is where is the safe haven for the money? Where is the safe place to put your currency? Take your currencies and put them in hard assets: gold, silver, Bitcoin, because those assets last over time. Those are durable goods. Those are durable things with a limited supply or a fixed supply. In an example of Bitcoin, Bitcoin is not a fixed supply per se. It's 21 million, and we're not quite there yet. We're almost at 20 million, and we're rapidly approaching 21 million. So again, supply and demand, that's what's going to happen. But the Federal Reserve, everybody's going to be talking about it today. Okay, I say big deal, right? 0.5%. Yes, it's going to negatively impact this stuff, but we've already seen that in the last couple of years, going from 0 to 5.5, and this takes 12 to 18 months to impact. So when it started getting to 4 and 5%, that's when we saw some banks failing. That's when we started to see real estate starting to take a nosedive, and bonds taking a nosedive. So now another interest rate went up, and they're saying that, hey, we won't do it again. 1/4 point. This is to indicate this is their general trend, that they're not done raising if they need to, but they're trying to walk a thin line, because the higher they raise these rates, the harder it is. All these issues arise. But if they drop the rates, now people will be borrowing, and now the currency supply will explode again, and they don't want that, because that'll be inflationary. So they are trying to walk the thin line of like managing inflation and interest rates without trying to hurt too many industries. But you can make a strong argument that it might be too late. So that's the kind of things that we talk about both here and over in Economic Preppers. I know this is more I try to be more in crypto. I will be more in crypto. I'll be doing more videos on other projects. Like I did that top 25 video. I'll try and post it up here. I did that top 25 video on both channels, but I'm going to dive deeper. And for those of you who weren't around a couple of years ago on this channel, I'm going to review the altcoinopoly, the altcoinopoly game that I played. And I'm going to show the whole board. I'm going to show all the different projects that are out there, how they stand, how they rank up. Are they still around? Are they still good? And then I'm going to start doing more and more videos on each of those good projects that are still around and why I like them, and add more credibility to them, and hopefully give you more education on those and why these are still sound projects to move forward with. So hopefully you enjoy this video. Leave a comment, like, share, subscribe, helps out the channel. I read every comment. But with all that said, I'm going to close the drawer on the bureau, say follow leader, and I will talk to you soon. Take care.